Now, at this point is where we want to turn to the U.S. and really look at what are some of the big things that have come out recently. And it's interesting when we start looking at that inflationary data set. And that's what we want to talk about, again, with the flexible versus sticky. Because that's where the pain continues and that structure continues to be a big hit. Because when you look at the sticky side, it's rolled over for sure. Like as we said it would, it's just the pace of the decline has been so painfully slow. And it's interesting because then you look at rents, obviously rents have fallen, but now they're bouncing back up. And you're seeing this pressure point where you'll get some cool down in the sticky side, but now flexible, which came in at a negative 2.6, you're actually seeing that bounce back a little bit. When you look at energy prices, you look at some of the different shifts, getting a little bit of that love to bounce back up, while sticky continues to be that inherent problem. So nearly all of the major decline in CPI has thus far been in flexible components. Sticking components have started to roll over, but it's been a very slow process. And until you get a much bigger decline on the service front, you're really not going to see a lot of that pressure. Core goods component of CPI reversed lower in year-on-year terms in June, while core service continued to roll over. But when you look at, again, core service and core service as well as core components, service and commodities, you are still inflationary. It still hasn't come into that deflationary point, that below zero. And that's, again, more issues when you look at, okay, well, the Fed's going to raise rates in July. I think, and we'll show you the data where there's the market puts a 94% probability on that. The question's going to be, what do they do going forward? And we believe that based on a likely reacceleration of, or at least, an elevated amount of inflation in July is going to keep them on their back foot and leave them open to one more rate hike. We do believe that one or two will be the peak. It's just the biggest thing that we're expecting is that you don't get a cut for at least 12 months. And the longer we're increasing rates, the further out that initial cut becomes. And that's, I think, where we differ the most with the street in general. Then when we look at on a month-over-month basis, CPI came in at 0.2 versus the estimate of 0.3. And then on a core basis, it came in at 0.2 instead of the estimate of 0.3. And remember, oops, I always play with stuff when I'm talking. I apologize. So when we're looking at some of these key pieces, the month over month, again, that is hitting people. Is it slowing? Yes, that means that people are not getting hit to the same degree, but they're still getting impacted by rising inflation month over month. Then you look at year over year. June CPI came in at 3% versus the estimate of 3.1. Core came in at 4.8 versus 5. So yes, on a year over year basis, you get this massive move up. The rate of change is slowing, but yet you're still getting this, again, walking it up. Every single month, we've still had some of this getting worse. And now June slowed, but given some of the things that have happened in July, it will likely see a little bit of a walk up from here and keep that positive for longer than really what they want to see when you look at that month over month pain to the underlying consumer. The CPI month over month core goods, you can see that rolled over. It's that services. The services continue. So until you see a meaningful rollover on the service front into some sort of contraction, that slowdown, you're going to see that core service side continue to be the essentially the crux of what keeps us elevated. Now, core goods could likely see a little bit of a bounce given what has happened on the energy markets and the food markets, but that's where it's that's something to see in general when we're looking at some different things. So then when we look at U.S. financial conditions, you continue to see some of the increases. At least three reasons can explain why the Fed is likely to raise rates in July. There's no sign of abrupt worsening of the labor market conditions. Home prices have remained resilient over the past few months amid the lower inventories, and U.S. financial conditions have improved since the end of May. So realistically, when you look at these pieces, the labor market, the unemployment world, the wage side, there's really nothing to say that they're at a point where they're going to stop. So I think we can all agree July happens, but what comes next? And I think that's going to be the thing. And based on some of these interlocking data sets, points to one more even after July. The U.S. Beige Book Activity Index, points to that slowing growth, but still not that recession. So when you look at the Beige Book, there's really nothing to say stop. Like we're in max pain, the recession, and a lot of that is driven by services. Manufacturing, industrial is showing you there's pain there. Construction, there's pain there. Services, not so much in general, but that's where we look at some of these underlying pieces overall. Bloomberg, when you look at the U.S. 2023 core PCE consensus forecast, here you can see that the latest is at 4.3%. It went up. Bloomberg US 2024 core PCE consensus forecast also increased. Now remember, this is for June. This is when you start looking into July. So there's still pressure points. There's nothing here that is showing that we're going to get this bigger rollover, and this is what they're looking at. Now, obviously, the inflation data, this is taken before that inflation data came out. It could roll a touch, but realistically, core was still positive. Sticky was still elevated, and that's really what core PCE is going to tie back to the closest is sticky inflation. So there's really not much that has changed, which is why we see a lot of those reasoning, especially on the service front, a reasoning for additional increases. Now, when we look at that target rate probability, again, that 95% likelihood of a rate hike, and again, not crazy to see that. Worth noting that so far the spike in Fed's balance sheet, which coincided with the banking stress, has been completely undone. But we've barely even scratched the surface of, taking back mortgage-backed securities, the MBSs, selling down some of the balance sheets. So every time we get close, you get a spike. And now that we're here, it's like, are we actually going to see some tightness in the liquidity side? Because remember, going back to Bernanke, he talked about, getting back below $1 billion. And right now we're at, $1 trillion. And right now we're at 8.3 trillion. So there's a lot. There's a lot of things behind that when you start to see some of this tightness, which is why I think it's interesting that people are so tied to this, don't worry, we're going to get these cuts. Retail money market funds is rising sharply, and this is the type of development that has preceded recessions. Again, when you look at .com, financial crisis, and for those that don't know, when I was at Morgan Stanley, I worked with the money market group, and this was back in 2007 when all of a sudden we went from investing 500, 600 billion in the overnight market to about $1 trillion, and then over $1 trillion, and a lot of that was money markets because you put it into the overnight market, to try to get some of that money, and there's a problem there. And as that increases, then you get that interest rates coming down. And that's where you put your panic money. It's like, okay, well, I'm not finding any real investments around me. I'm going to park it there. Savings, same thing. Like there's no reason to keep it in savings until you get that saving rates going up. So you go into the money market, and that's going to be an important piece. But then the household net worth is now contracting at the deepest level since the 2008 financial crisis. And this is when we start looking at services. This is when we start looking at the savings rates. And that savings spend down, net worth continues to deteriorate. Now, the cost of living has improved because of mortgage rates. When you take the average mortgage rate, that has improved. People were able to lock in great rates. But when you start looking at holistically speaking and the net worth, when you look at how savings has been drawn down, credit continues to get more expensive, you're actually seeing, again, that squeeze, and the squeeze should hit services the most. And that's why when we talk about that slowdown in services, we're looking at things like this and some of this, really kind of continuous pain that's going to strike. Now, when we look at real after inflation annual returns since 1927, the long-term look at correlation between inflation adjusted returns and the 10-year US Treasury, 2022 is that red dot, and you can get an idea of very weird timing. And it's interesting because everything in this in this quadrant is, the 70s, early 80s. And that's one we like to talk about because when we look at some of the pivots, we see pressure points in terms of where inflation's going to go. It's going to be sticky. But commodities aren't, even though demand's coming down, you're getting that supply crunch. And that's why that real side hits the hardest, because it may look okay on a nominal sense, but then when you start walking back some of that pain, you get an idea of where these splits are. And we still are in a fairly, we're still in a fairly accommodative, and I know it doesn't seem like that, on a real rates basis, which is why, again, you're going to see those real rates continue to creep higher because we still have inflation. It slowed, yes, but we still have inflation, and that's going to impact realistically earnings and some of the other impacts when we start looking at the stock market. Average interest rates for all credit cards accounts going back to 1994, we are now over 21% or right at 21%. We have another chart that will go back further in time so you can see on some of those key pieces. And then the leading economic indicators in real GDP, realistically, leading economic indicators have started to trough, but you're still at a steeply negative number. And where that real GDP, and again, that pull down, that drawdown coming from the pain on the credit card, coming from the decline in underlying wealth. And then when you layer that with the, I think the purchase price, and remember the price index for homes has pivoted a little bit higher again. And that's when you start looking at wages, and this is what the Fed wants to avoid, a wage pricing spiral. So either wages have to pivot hard and explode higher, or we need to see that pressure to the downside on that housing price, and that can really only come from some of these pain points, specifically from raising rates and bringing prices down. And the U.S. government bond 10-year yield, whenever it crosses over 4%, you get a blow up, which I think is kind of interesting. So right now it's kind of waffling at that 3.99%. And that's going to be an interesting one to watch because remember, we do see, one more shock to the upside, and that's going to be a bigger pressure point. All the while, when you look at Redbook retail sales, it's the first decline since COVID, and consumers have really started to slow. And that's what we like to look at when we're starting to talk about retail sales. Redbook retail sales fell for the first time since COVID. Consumers are taking on less credit thanks to the tighter standards. Now they are spending less at retailers. This has marked the start of the last 3 recessions. The U.S. consumers have started to slow. And for those that have been listening to us, we said that March was really the peak. And we've been pretty aggressively slowing from that point. But again, it wasn't that we were going straight into negative territory. It's that we had a big slowdown that accelerated. And you can see how we've had some sizable step downs. And now we're finally to that pressure point of negative. Total merchant wholesalers, except manufacturers, sales, offices, the inventory to sales ratio, again, continues to creep higher as sales are slowing, inventories are building, and you're getting some of this this back shift. And based on what we've seen in trucking, what we've seen in shipping, it's not because this isn't like some destocking, it's just this is people not buying. And inventory is building up. Now, when we look a little bit forward on a month-over-month basis, the headline and core for PPI inflation increased by 0.1%. But remember, this is a reversal from the prior month where PPI was down. Now, remember, PPI being down is a leading indicator for where CPI is going to go. But now PPI's pivoted back up on a month-over-month basis. So now you're getting a little bit of that little bump to the upside. And it actually accelerated again when you take the average on the core front. So disinflation carried in June PPI on a year over year, came in at 0.1 versus the estimate of 0.4. Core came in at 2.4 versus the estimate of 2.6. So you're getting it on, remember, the year over year side, but think about this is where you're going to see supply side inflation. So the supply side was massively impacted. So you're seeing that come out. But now as things flatline, and then you look at the month over month, you're like, well, things were improving. And it's like, well, now they've stopped improving. And now you're starting to get some of those big, really heavy, terrible months fall down. And as that falls down, well, now you're starting to see a little bit of that bump back up. And as the bigger numbers come out of the market, and that's where, the Fed is going to watch this closely. I think July's numbers are going to be important in August, but we're seeing, again, more of that sticking power, and we need to see realistically the consumer, those retail sales fall harder in order to really start to ratchet some of this down. Then when you look at the spread between core CPI and headline CPI is at the highest since September of 2015. There's no particular relationship with recessions when looking at history, but it's just interesting to look at the core side that big prevalence between the sticky versus other. In a win for workers and a courtesy of easing inflation, real average earnings growth has picked back up into positive territory. And so that's good, but remember, that's also a problem, because if people feel like they have more money, does that mean they spend more? And all of a sudden, instead of retail sales coming down, you get this big pivot back up. And that's going to be that wage piece that we're going to want to watch for. Then when we look at the NFIB through June, net 29% of small businesses reported raising prices compared to the 3 months earlier. However, net of 31% expect to raise prices over the next 3 months. So again, you're getting that pivot back up where people are like, well, we have to raise prices a bit, and it's trying to protect margin. Poor sales are not yet a major issue for small businesses, but it has tended to be more of a coincident indicator, which happens simultaneously, not a leading or lagging, but kind of at the same time. Surging most when the economy was in the thick of the recession. So again, it happens kind of at time, but that, again, there's just more of that inflationary. It's like, well, prices came down. Now we have to try to hold here and see if we can hold this line. Here's a different category of some of the drawdowns. Fuel oil, gasoline, airfare, natural gas were the biggest deflationary drivers. And if you look at Brent at 80.50, you look at fuel oil, you look at gasoline, it's like, well, some of that is going to wash away, and you're going to start to get some of these increases. And again, that's why we talk about how it's not going to fall as quickly, and a lot of that will be from some of that inflationary uplift. CPI, urban consumer owners equivalent rent, it's rolled over a bit, but again, it's still very high, coming in at 7.8% year on year. And then it'll keep falling because this is a lagging indicator in terms of, the correlation. So it'll keep falling. But what's happening today is a little bit of a bump. So it'll come down, and then it's going to actually start to rally back up. And that's where, when you look at, as we can compare it always back to the 70s, when you look at this in comparison to the Fed, starting to ease rates, rate hikes in 76 into 77, into 76, and then all of a sudden you got this massive explosion, it's because they did it too soon. You had this big pivot happen quickly. When you look at back to office metrics, showed an average activity recovery hovering at about 50%. So again, you're still, and this is just taking the average, and then you're looking at New York and San Francisco on the coast. So still, you're not getting people back in the office. If you think that we were closer to 98%, we're at 50%, and that's a real impact when you look at underlying gasoline and underlying crude demand. Small business expected credit conditions improved a bit in June. It's still low, it's still negative, but again, this is what the Fed is looking at. The Fed doesn't want people borrowing. They want rates to go up, and that's going to be that additional pressure point. Diffusion index of every possible yield curve inversion, we're still at about 90%. All the while, the Conference Board leading index, 6 month over 6 month is negative. Again, showing that inversion and that pressure to the downside. Again, showing those slowdowns that we've talked about. Now, when we start looking at the massive pool of undervalued Chinese labor, is now gone. So when you start looking at Chinese labor, and this is the reason why we're talking about it here, is this was deflationary for us. We exported inflation and we imported deflation because we were taking advantage, if you will, from a very cheap labor force, and that's now gone. China's youth unemployment is higher than in the G7 countries. So again, it's going to be difficult when you look at the inflation structure, where for the late 60s, 70s, we were exporting inflation, importing deflation. And that's, again, that's cresting over and really starting to slow. And that's going to be an inflationary driver for us going forward. Work from home hits offices. When you look at commercial property, office property continuing to slow, banks don't want to lend. Well, why would you? Why would you go into non-residential commercial real estate given where we sit today? And that's why we see more pressure and more pain coming on that commercial real estate front. U.S. market implied terminal rates, as we've talked about, is at 5.4%. And this is really indicative of at least one, but most likely two increases in rates. Now, this has come down a bit now that we've had some of the better information coming from the inflation side, but it's not going away in total. While the households likely will seek to save more later than this year. And when you look at that excess savings, it's interesting because household liquid assets in 2019 prices is already gone. And that's what when you start looking at this and the national savings side is why we've seen, or we think we're going to see a bigger acceleration to the downside of activity. Monetary policy has become more restrictive. And that's something that, it's become more restrictive, but depending on the metrics you use, which is why it's so important to look at multiple metrics, some of it isn't as tight as it seems. And that's why there's going to be a lot of back and forth to kind of maintain some of this. The small business survey indicates credit conditions remain tight, but not as tight. Expectations are for tightening, net 6% reporting credit harder to get, net 8% expecting credit conditions to tighten. So again, it's improved, but still on a tightening basis. Then when you look at bankruptcies, well, bankruptcies are starting to increase. You're starting to see that pain pivot through, and it's going to take time. And that's why we talk about the issues with zombie companies and the need to kind of flush out some of these weaker industries. Weighted average of U.S. surveys and GDP, decent rebound in the ISM services index, although an average of that in the manufacturing index still points to the stagnation, which is very likely. But the important piece is, again, always kind of leveraging that back from services to spending. Well, spending per household based on Bank of America's aggregated credit card and debt card data is negative when you look at a total card usage, total card X gas, retail, which is why, again, we see those pressure points, those slowdowns are going to accumulate over the next few months. Rising bankruptcies point to the greater charge-off rates, and the charge-off rates are why banks are going to remain restrictive. They have to make sure that their bad debt is covered to to protect balance sheets. Conference Board labor differentials versus NFIB, small business expected credit conditions and loan availability. So again, you're seeing some of this spread, but there's spreads everywhere. And the thing that is happening, which is why we have this frothiness in the market right now, is that you're going to get this snapback, especially when you start looking at how the alligator mouths are really kind of widened. You'll get some of these movements, but it takes time to feed it through. The non-revolving credit contracted in May by 1.26 billion, the first decline. So you're starting to see it, like consumer non-revolving is ratcheting down a bit. But then when you start looking at household borrowing more to maintain spending, they are, and when you look at June 23 versus others, but again, that is maximized, that's peaked. And now as that tightens up, that's when you're going to start to see a bigger slowdown in the service side, as well as that activity, which is really going to be the meaningful slowdown when we look at GDP calculations. So that's what we have for you on that piece. In the next segment, we're going to go deeper into savings, labor, and then the real estate market.